we talked a little bit about how at 7 o'clock, at 8 o'clock, and at 9 o'clock, the immediate 30 minutes after that, or each one of those top of the hour intervals, we want to anticipate a opposing direction in the marketplace. So the assumption is you have already identified after 7 o'clock in the morning New York local time a relative equal high or relative equal low, or where price is smooth. Okay. And then you're anticipating, you're not arm wrestling the market, you're not forcing that it has to go there because you now see it, so therefore it can't do anything but go there. That's not what you're supposed to be doing either, which is why I taught you in the first two sessions together, is just to relax and observe. You have to observe. You have to sit back and watch what does price do and record your observations. If it means taking screenshots as price is going and moving around, and it may not be near anything of any particular importance, like an order block or a fair value gap or something like that. And no, Kimmel, an inversion fair value gap is not just a fair value gap. There's two distinct things going on there, but it's okay. It'll be in the book. The idea of you using these intervals as a starting point, a delineation in time. So, okay, now I'm really focusing. It's 7 o'clock in the morning. Whatever's happened overnight during London, whatever's happened in the previous day's trading, I'm not factoring anything in yet. I want to see the design, the engineering of liquidity. And what does that mean? When price creates these really smooth areas of relative equal highs or relative equal lows after a session changeover, meaning at midnight New York local time, that is the beginning of true day. That's the beginning of the real true day in financial markets. So the algorithm likes to refer back to that time, and then everything since that time, it'll refer to for the purposes of liquidity or inefficiencies. Outside of that, you'll have things like new week opening gap and or new day opening gap, which is what you see here on the chart. New day opening gap. What that is, and let me just maximize this chart. Well, actually, let me do it on a 1 minute chart because it'll be a little bit easier for you to see it. Every day, except for Friday, this is for specifically the index markets. Okay, so while I'm teaching my son how to trade and make money in that asset class, this is not something to lose your mind over. It's really simple. At 5 p.m., again, every day except for Friday, the market closes at 5 p.m. It stops and it pauses for an hour, and then it resumes at 6 p.m. Eastern Standard Time. If you take your 1 minute chart, you don't have to have live data to do this. It's something that is a long-term effect on price action. It'll be used for weeks, okay? And I'll explain it in a second. Here is the 459 candle on a 1 minute chart. My candles that are bullish are green, and my candles that are black are bearish. So the up close candle, that is the closing price where we stopped, and it's the last print for NASDAQ on Tuesday going into the 5 o'clock stop. And then at 6 o'clock, all you do is simply get in front of your computer, wait a couple minutes right before 6 o'clock, and wait for the first print on a 1 minute chart. When it opens up, that opening price, you drop a line segment on it, okay? And what I do is, all I do is I take this little line thing here, a horizontal ray, and I just go and I drop it on the opening price. And you can annotate it any way you want, okay? I know some of you folks that are on the other side of the pond, if you will, you don't like to see our numerical version of, like, today's date for me would be 08/07/24. And for you across the pond, you would probably see that as July 8th. And obviously it causes confusion. So I generally don't annotate it like this, but for the purposes of not confusing anyone and for completeness sake, when you highlight and annotate your chart, you have to do this. Okay, this is the part. If you just put these lines on your chart, and you're going to have about 5 of them, because you're going to use the present week, or if it's on the weekend, the new one that forms on Sunday's opening price. You annotate that on your chart, and then you'll have 4 more prior to that. So you're always going to have like a floating reserve on your charts of 5 weeks of new week and new day. I'm sorry, for new week opening gaps. 5 days look back for new day opening gaps. New week opening gaps is 5 weeks. So when we have these levels annotated like this, you can call it whatever you want. You can label it the way you want. But I taught my students that this would be referred to as the new day opening gap high. Now, why is that? It's the new day opening gap high because at 7 o'clock in the morning on Wednesday, and yes, that gap forms technically on Tuesday evening, my local time in the east coast of North America. But that's really technically a gap or inefficiency that is attributed to and should be used for the basis of Wednesday's trading. So it's a little confusing, but if you rewind that and listen to it again, it's pretty straightforward. But at 7 o'clock in the morning, there's 7 a.m. And if we scrub this down here, you can see that we are way above that new day opening gap. See that? And since this is the first level you would come to, that makes it what? The new day opening gap high. And then the next level below it, which would be whichever is the next reference point. You can have a gap. In this case, we have a gap that has gap down. So where we close here on this candlestick there on Tuesday at 5 o'clock, we open lower. You see that? Now, when we drop down to it here, what we have done is we left this portion between this candle's low or whatever this one is, whichever's lower, that little segment of inefficiency is still present because what is it lacking? What's it missing? Sell side delivery, not sell side liquidity, sell side delivery. Okay, so if you look at this candlestick here, we opened and traded up. So there's nothing passing down into that candle's low, or I'm sorry, the opening price. It's not offered yet. So when we annotate our chart like that, these gaps, okay, these gaps will be referred to for a week. Now sometimes you'll see they actually get referred to a couple weeks later. Still, they'll be sensitive because they're real algorithmic arrays where the market will refer back to them. But I'm not going to be able to teach you every aspect about those things because to do that opens a Pandora's box for me and I'm not going to do it. Okay. The fact that these exist and once they get traded to, anybody else that looks at gaps would think, okay, it filled the gap and that's it. Throw it out the window. It's done. It's over. Kind of like how the myopic view of supply and demand where they say, I need a fresh zone. Everything I serve up as a PV array is piping hot and fresh every single time. It doesn't get stale, okay? But for the rule-based idea trader in you, new day opening gap, this is the part where you write down your journal, folks, or your notes. New day opening gaps have a life cycle of 5 days, okay? You can use them longer if you want to. But for the teaching purposes, when I taught new day opening gap first, I taught it on Twitter. I introduced it there in Twitter Spaces, and I talked about it as a after fact and made its way into my lectures on the YouTube channel. They can act like magnets where it draws price back down to them because these levels, these gaps, have real value in them because there's an absence of any real trading. Even when you see them open up initially here, we can see that it opened there, it traded above the previous day's close, does so here, and comes back down, and then runs back up, stays around in here, it runs back up, stays around here, drops, consolidates, drops a little bit, and leaves a small portion. If you take a Fibonacci, okay, if you take a fib, and you drop it on the lowest open or close, if we let me say this part first before I get any further. If you look at it from here, I'm going to zoom in, use this little thingamajiggy here. Zoom in real tight. Here's the closing price on the Tuesday at 5 o'clock. We opened down here, so that's a lower gap opening. The opposite would be this, where we opened above that closing price. So if we opened up here, then you would draw the same lines the same way, and you're using this ray down here. That extends it in perpetuity. It keeps going to the right. It never stops projecting it to the right. And your annotations, when you annotate them, put it on the middle and to the right, and then you label it. Real important that you put the date in it. Whatever format you want to use, it's up to you. But that format, or that date rather, helps you organize the level of importance. So what does that mean? If you have a new day opening gap, say for, I don't know, 2 months old, okay? 2 months old, and we haven't referred back to it since the day that it formed, and then in that instance, I would find it important. I have a journal page, a spiral notebook basically, and I write down every single new day opening gap, high and low, and its midpoint or consequent encroachment. And I'll explain what that is in a second too. And I keep a running log of that. And as long as we're 150 handles in close proximity to any one of them, then I personally will look at them. So I'm kind of like showing you my hand a little bit today. So for you, because it's something probably new to you, and you're probably going to have a whole lot of them on your chart because you're going to think that you have to have every single one of them forever. It's until until you run away from all the ones that you're presently trading around. You don't want to clutter your chart up, but I like to see them. And in my journal, it has a spiral, page that it's basically a column, and I write down what that market is, and it's usually just the S&P and the NASDAQ, and sometimes the bond market. The high and the low and the consequent encroachment and the week that it opened up and formed. So for instance, this is for Tuesday, okay, on the day it formed. But is it for Tuesday's reference? No, it's for Wednesday's trading, and that's why it's labeled that way. Okay, so you're going to use the next day after the 6 p.m. candlestick. So if you look down at the bottom of the chart down here, it says Tuesday, August 6th. But really what we're doing is we're building a reference point for Wednesday's trading and for the next 5 days. So that means this will overlap into next week. 5 trading days, not 5 calendar days, 5 trading days, okay? If you have a holiday, skip that and add one more day to it. And that's kind of like your life cycle for new day opening gaps. New week opening gaps go back with a life cycle of 5 weeks. So you're always going to have 5 weeks of new week opening gap. And a new week opening gap is where we stop trading on Friday at 5 o'clock, and then where we open up at on the Sunday at 6 p.m. And then you mark it the same way here. The only difference is you would say NWOG, which is new week opening gap. They tend to be very sensitive still 5 weeks back. Now, that's not it's ended at 5 weeks and you can never refer to them again, okay? It's just a general rule or principle that you can start with. You're going to discover that they work 6 months, 9 months still away because they are actual places where the market didn't really efficiently trade, as I'm showing you here. But if you take the levels, once you have them on your chart, you want to, on TradingView, you want to create a, I don't know what they call that. Let me do this real quick. Whatever this is called up here, layouts, okay? You want to create a layout that has a title that maybe it's new week opening gaps. And on that layout, the only thing you have referenced for the market that you trade or markets are simply just the new week opening gaps. And or you create a layout that has the only new day opening gaps or new week opening gaps rather that is salient to your market. So that way, if you're ever watching price action, or if you start your new trading session today or tomorrow or tonight, whenever you trade, when you pop up one of your layouts, you'll have the information right away populated on your chart. And you don't have to have all that stuff on your chart when you're working with the chart time frame that you're exercising or executing on. So I'm saying that for the folks that are working, because I'm physically sitting down with you with a laptop. So I don't have all the multiple charts or screens in front. I mean, they're in front of me, but they're off. But I'm trying to teach it from a perspective of using a single device like one laptop. So that way it helps you manage your information and not clutter your chart all up. But once you have them on, this is how you get the other levels that are important to me. You use the low, drag it up to the close, which is the high or new day opening gap. And here is your consequent encroachment. That's the midpoint, okay? That's not equilibrium. It's consequent encroachment. Why is it consequent encroachment and not equilibrium? Because equilibrium is a range that has been delivered up and down, okay? Think of it like a trading range. This is not a trading range. It's a gap. It's a real gap. So that real gap has a missing level of buying and selling. There's really no buying and selling yet because we stopped trading on the previous session at 5 o'clock and then resumed trading here. So there's nothing being offered as a buy or sell, no printed trades until that opening right there. And then it starts trading. But what is it doing? It's delivering buy-side delivery. That means it's going up. So what is it lacking? Sell-side delivery. If we take this level here and we add 75 and 25, 0.25, 0.75. What that does, it grades into equal quarters the range, okay? Watch what happens. Look how it stops perfectly right there. What's that price? 18,049.50. It stops exactly right there. Right there. Look at that candles. Look at that candle's low right there. Right up here. Look at that price right there, okay? What's the low of that candle? Folks, that's fucking perfect, okay? Perfect. You can't improve on that. You're going to tell me buying and selling pressure, stop that right there? Some random bunch of jokers out there looking at goofy stuff. They stop the market right there? Okay. Look how price gravitates around the upper quadrant. See that? See how it's gravitating around that? And it expands just a little bit. Let me take this off because you're probably thinking this has something to do with it doesn't have anything to do with this. Let me take this off. These are extensions for like swing targets and stuff. So the last time we talked, I was showing you yesterday's live session. That's why that was on there. And if you don't believe me, go back and look at the recording and you'll see those levels were actually the ones that were highlighted in my fib. So here we have the upper quadrant, midpoint or consequent encroachment. Consequent encroachment is the midpoint of any gap or any inefficiency. Okay, that means if it's a SIBI, that means it's a down close fair value gap. The midpoint is consequent encroachment. The best shorts will form at the lower half of that because you want to see the upper half left open. A midpoint of a BISI, which is an up close fair value gap, the best fills for going long are going to form in the upper half of that. You want to leave the lower half open. Why? Because you want to see it create a breakaway gap. That inability to fill in that area down there, and if it rallies, that indicates to you that the algorithm is really going to start spooling quickly and you anticipate large range expansions. Holy shit, I'm dropping some diamonds today, aren't I? Yes, I am. Because it's 2024, baby, and it's about time for you to start making some fucking money around here. So this lower quadrant, beautiful. Consolidating. It trades just outside of the new day opening gap. And the market trades down. Look at the sensitivity on the upper quadrant. You see that? See it? Look at that. It's staying very, very close to the upper quadrant. And then boom, we trade down to consequent encroachment. And then one more time, look where it trades. That lower quadrant. Does it one more time just to take the low out, but does it come down and touch the very, very low of the new day opening gap formed at Tuesday, 6 p.m.? No. So what's it doing now? It starts to rally higher. We have this little segment of price action here that is inefficient. There's no trading down there. Once it formed this low, it starts moving higher. If you have these levels on your chart, even if this was to come down and touch that low here and then moved out of it, that does not make this high, that midpoint, or that low stale or of no consequence or importance anymore. It's still meaningful to me for 5 days, 5 trading days. Okay, so if this is for Wednesday, this is for your notes. Make sure you write this stuff down now. Since this formed on Tuesday for Wednesday's trading, you have Wednesday's trading, so that's day 1. Thursday's trading, that's day 2. Friday's day 3. Monday is trading for day 4, and then Tuesday. So this new day opening gap is still valid until Wednesday next week. That's how I would classify it. Okay, so that way if you have any confusion about how long they're useful to me, or not that they're not useful, but I love the sensitivity around them for the next 5 days. Let's say it that way. I think it's a better way of representing what I really mean. But in truth be told, I will use them 9 months in the past if it's within the narrative I'm expecting to see price behave around them. And that part is experience. So just know that what I'm showing you here is gold, and I'm going to show you how to use it a little bit more specifically because it's my son that's actually the audience member I'm aiming for. So we can see how the market leaves that area. Yeah, there's no algorithm. Here's 7 o'clock, here's 8 o'clock, here's 9 o'clock, and we were way above it. We're really north of it when it formed those opening intervals. So 7, 8, 9. I must have moved that line. I apologize. I was looking at those lines and I'm like, they don't look uniform. Yeah, so here's 7, 8, and 9. And we were way above it. So here we are. Oh, there you go. While I was talking to jawbone, it went down and closed it in. Okay. So if you watched it at the very beginning, the recording's still there. I'm going to delete the recording of the first attempt to try to do the live stream. So you'll see this. It was actually in the chart beforehand. But it's not a big deal. I mean, most of my students already know about new day opening gaps anyway. But the ability to want to see it gravitate back to them every single day, if you have the last 5, like the week you're trading in right now, that's 1 week of it, or 1 day of it rather, and then you go back the last 4 trading days. So you have 5 of them on your chart, and as long as we're in close proximity to them, they're going to be impactful to your trading. And if you're bullish, if there's one above you, but there's several of them below you, now this right here, folks, this is gold dust. Okay, if you have a clustering of new day opening gaps, predominantly above where the market's trading at, and maybe there's one where you're trading at now around the market, or maybe it's below you, where do you think the market's more likely to go? Oh my goodness. Oh my goodness, I'm getting moist. It's going to gravitate where the multitude of inefficiencies existed, because it's going to give the market an opportunity to go back there again. Why? Because there are people in this industry that trade with this information that you're not supposed to have. And it provides that vehicle of entry, that mechanism of repricing up there. It has absolutely nothing to do with buying and selling pressure. As much as those little goobers that write those books and sell courses tell you, it's not how it works, folks. That's not how it works. And if it breaks your heart, God bless you, get over it, because this is what really makes the markets move around, time and price. But you have to have reference points to know how do these markets book price, because they're going to use these hidden areas. Oh, they're not hidden, ICT. Everybody knows about gaps, right? And look at everybody else's use of them. It's going to be a gap fill, and then it doesn't fill the gap. It runs away. And then the gap's used later on at some other time. And once it fills, they're not always interested in it anymore. A la Chris Laurie. He'll say there's an inefficiency, a buy-side imbalance, as we call it, buy-side imbalance, sell-side inefficiency. He'll call that a liquidity void. That's not a void of liquidity. It offered buy-side delivery. There was buyers going on in there. What's absent? Sell-side delivery. That means moving right back over top of it, and, tamping over top of that run up in that single candle. Okay. So now, what's the difference between a new week opening gap and a new day opening gap? Well, there's 5 new day opening gaps in the course of a week. You only have one new week opening gap. So, what do you think has more impact on a swing trade? A new day opening gap or a new week opening gap? A new week opening gap, because you're factoring the imbalance and inefficiency of a new week opening on Sunday at 6 p.m., where they've had a whole weekend to digest everything, and they use that opening price. Who's that? Those individuals that are in control of the marketplace. I know you don't like to hear that, and I know it pisses you off because I talk in a very condescending tone and arrogant, pricky, and all that other bullshit. But if you took the time to investigate in things that I'm telling you, you'll see that it's there. This isn't retail buying and selling pressure. It's not large funds buying and selling pressure that's causing them to turn, because that's not what happens. Doesn't matter. How much buying and selling pressure has absolutely no bearing on it. You'll be able to sit down and predict with a high degree of precision and accuracy where the market's going to gravitate to. That's the very first stage in your development. That is not profitable trading. That is not precision entries. That's not tight stop losses and low risk management. It is the first stage. If we have a clustering of new week opening gaps below the marketplace, okay, I'm going to elect to see price try to gravitate to that. That's not a hard and fast, only going short. It just means that if I'm going to look for a long, I'm going to wait and see right away, do they want to drop it down there in that direction? It doesn't mean they have to trade to those group of new week opening gaps or new day opening gaps. Either or. It's a filter that my mentorship students don't even know anything about. They're grinning right now because they're learning just like you are. And when you have these things recorded in a layout for your chart, you'll be able to see, oh yeah, there's a number of new day opening gaps and a couple new week opening gaps that are below price. And if you've seen, we've only worked it one time. In other words, like we've seen it here, it went down into this one. This is the first time we passed down into it. And this is the second time we passed down into it. Okay. If we've only touched the new week opening gap or a series of new day opening gaps once, they're really sensitive, like they're hot. They're going to be they're going to see price draw back to them. That's just a guarantee it's going to happen. And there's very few guarantees in price. There's very few guarantees in trading. But this is something that you're going to study and you're going to see. What I just said is the gospel. It absolutely is always there. And that right there cancels out the whole idea that these markets aren't rigged, because why would it care? Why would it care about a gap that filled weeks ago? Why would it do that? Unless it's being called as a reference point through coding and it's referring back to a certain span of time. Almost slipped. Let me slow down. It's a very specific reference of time that the algorithm will seek and look back to. Okay. And by having that look back period and looking at these reference points in price, so you have time and then price. And when you can identify these things, and they're never going to be able to hide where they opened the price up in relationship and in deference to where we closed it at 5 o'clock. Can you understand that much? If you're brand new and you're thinking, okay, this is probably going to stop working because it's being taught. I taught this and it still works beautifully. It's not going to stop working. Okay. Believe me, if I believed any of this stuff was going to stop working, if I taught any of it, you would never know about it. Okay. The things that I teach, they're just very market generic. They're going to behave this way all the time because this is the source code. This is exactly what it's going to do. It's always going to do these things until they tear the markets down entirely. This is what's going to be there. So as long as we can trade markets, these advantages are going to be available to you. And that should excite you. It should give you passion and desire to spend more time seeking them and understanding the characteristics around them. And what this does, it gives you a magnetized reference point of where bias can draw to, even before relative equal highs or lows form. Wait a minute, slow this down. Slow your roll, ICT. Say that one more time, because I think I just heard you say you can predict relative equal highs and lows before they form. Yeah, you're fucking right. Yep, that's exactly what engineering liquidity is. That's exactly what it is. Okay, so if you have a predisposed um, likelihood, if it's likely that we're going to draw down to a new day opening gap, or we're going to draw down to a cluster of new day opening gaps that haven't been traded to or used much, or a new week opening gaps that are clustering below market price. At what time? At what time, ICT? At 7, 8, or 9. You're referencing. You're trying to get a feel for what is it likely to do? Sure, there's going to be volatility. Sure, there's going to be probably all kinds of movement around. But what was the market showing us right away? Well, it's got relative equal highs, but it's also got relative equal lows from 7 o'clock at 8 o'clock. Okay, so if we know the new day opening gap is down here south of all that, down here, we know that it's probably going to run these highs. So you as a trader, Caleb, you're going to be thinking, all right, I know that this is a gravitational pull on price. The algorithm is going to want to revisit this. Okay. If I notice that there's relative equal highs after 7 o'clock, that was the rules I gave you. There's no guidance from ICT, by the way. There's no guidance. There's no rule-based idea. He never tells you how to do it. It's just he talks vaguely and he reinvents things and renames stuff that other people wrote about. Here's the high and the second one. Okay. And the market drops down. Do you chase that? No. Uh-uh. Why? Because you have a new day opening gap down here that it's most likely going to trade to. Okay. It doesn't need to trade there today, as I'm going to prove to you in a little bit. Okay. You can be profitable without it never reaching that. It could do that return back into it here in London like tonight. It could trade there in London tonight if it hadn't dropped down there. And that's what I would have done looking for a trade in London. Okay. I know some of you are thinking, oh, here, I would have, could have. Trust me, you're about to see an execution. Just sit your ass down. These highs here, that would be an ideal scenario to run those highs out. That would be a fake move. So that would be a Judas swing, okay, as we referred to before. If we have a predisposed direction in mind where we want to trade, where there's a larger draw or gravitational pull on price that's outside the parameters of just relative equal highs or relative equal lows, because that's just one piece of it. That's just a piece of it. So you want to have a tool, a weapon, okay, a weapon in your arsenal that will help you understand with more probability, more odds in your favor that the market's going to gravitate to a very specific range in price action. And that range needs to be a new day opening gap or a new week opening gap, Caleb. That's your black hole, if you will. It's going to draw price to it. It doesn't mean it's going to be a straight line to it. It just means that it's going to have an overwhelming impact on the overall direction of what price is going to do. There may be static price action moving around. It might have a little bit of flurry of rallies here and there, but ultimately it's going to bend a knee and go right to where it needs to go, which is the new day opening gap or new week opening gap. Okay, so this is engineering liquidity. As the market drops down, we would never go short right away after seeing new start of a new AM session at 7 o'clock and they have relative equal highs, especially if we're thinking a new day opening gap is a draw. So what we would rather do is we would rather see it trade up and cancel out this liquidity. So as it's dropping, traders are going to chase that. Think, yeah, this is really good. This is easy. All I got to do is follow the moving averages. Okay, do your stochastics overbought and oversold. You take your profit and wait for another overbought and go short, right? Well, this level you would have on your chart, and you would observe that. Okay. Above this high is buy side, okay, buy side liquidity or buy stops. The market rallies after 9 o'clock. We get this little squiggly line here, and then it runs, pumps up above it. 1, 2, 3, relative equal high, then breaks down, and then creates another relative equal high. Are we more likely to clear these highs here if we have what I've been teaching you here? The larger draw, the more influential draw on liquidity are new day opening gaps and new week opening gaps. That's the real hidden, that's the magnet on price. Okay. And when you start mapping them out on your chart and keeping them active on your chart with the time reference points that I've told you, like the life cycle of them, for the sake of having more time used with them, you can create an additional layout on TradingView where you keep them for as long as you want. Okay. But just understand, knowing how to use them and managing them when they're older, just you have to keep track of how many times they've been referred to. And it takes a little bit of effort. And most people don't want to listen to me teach something that's going to make them millions of dollars if they put their asses to work with it. But hey, everybody wants to do their own thing. You can see the power of using this information once you start logging them in your own charts. You're going to see them in your charts once you have them. You're going to watch price do all kinds of silly shit that people on YouTube, on Twitter, on social media, if they're making their opinions vocal in public, you're going to start smiling. The corners of your mouth are going to start aching because you're going to be smiling, grinning your ass off because you can see them falling victim. They're literally falling on the sword of the market, and then they're going to get sucked into emotion going right down to these levels or up to these levels in deference to when it's bullish. But you're going to see it, and you're going to watch it unfold, and you're going to have a perception over price that you've never imagined before. When you place the effects of what street money will see in price versus what a smart money perspective is over price, you literally are arm wrestling the strongest man in the world, expecting to win. It's not going to happen. And this repeats every single week and every single trading day because the retail crowd, number one, they don't even believe, most of you listening to me, you probably don't really believe there's an algorithm, but you entertain me because you think this is something like a nervous tick I got to keep talking about or whatever. At this point, if you don't see it or believe it, there's no hope for you. There's literally no hope for you in that regard. You don't need to believe in an algorithm for it to be profitable. You could say, well, I'm going to suspend my belief about it, and it's not important to me. I just want to trade something that works. Okay, wonderful. But you can't knock me for telling you what's really going on because I'm not lying to you about it. It's really there. And these are the reasons why it repeats. Because if it's an algorithm, the algorithm does the same things all the time because it's following a code. It's following the syntax and coding and the logic that was used to create it. And it has to refer back to old information. It can't pull stuff out of its ass. It's not a real thing. So it has to use instructions like a recipe. Okay? If you have a recipe card, you pull it out and say, okay, I want to make chicken Alfredo. All right, what ingredients do I need? I need this, 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 this. So the recipe is calling your attention to, well, before we begin, you have to have a measuring cup of this much Parmesan cheese and this much of this and cream and whatnot. You have to have all these information laid out in front of you, how much we have to have. But then you have to do what? You have to execute on that and get those ingredients measured out, and then you combine them. Well, the algorithm has to have that information to cull from. It needs to go back in time where it has delivered price before, and it's based on date, day of week, month of the year, week of the month, what quarter of the year, and what price and what time it was trading there. That's the real fucking nitty gritty, baby. That's what's going on. It's going back to those reference points. It is absolutely has nothing to do with how many times a level was traded to and now it's created resistance. Because everybody stopped buying it because it went there before. This didn't stop going up because it ran out of buyers. This didn't go down and not go higher because it was more sellers. But that's the bullshit that you're told. There's a lot of talking heads that get paid a lot of money going around the world teaching that nonsense. There's a lot of people that go on TV and talk about this stuff and say that that's what's going on. And people eat it up. Eat it up. Oh, yeah, that's exactly what's going on. That is absolutely not what's going on. That's not what's going on. The liquidity above these highs, it's traded to here. And then it runs a little bit higher and a little bit higher. And it creates a relative equal high here. And this is designed in engineering liquidity. And this is the part that where if you're anticipating a breakout move, you don't get filled. But if you're short, you're getting punished all day long because they don't want you a part of the move. You have to wait. If you have no data, no reason for them to manipulate price in the morning session, okay, write this stuff down. If there's no data, medium impact or high impact in the morning session, try to trade the afternoon session because the cleaner price action will be after New York lunch. When does that happen? As early as 1:30, but starting between 1:30 and 2:30, there's usually some kind of a sweet spot that forms in price action where it's just really, really easy to see it. And even if you miss it, you can start using what I taught you yesterday, where you can use a very sub 1 minute chart and get in sync with the price run that's already unfolding on a higher time frame 1 minute or 5 minute chart. Okay. Well, we have this low here and we have this low here. What does that make that? What is this right here? Relative equal low. Does it meet the criteria I gave you as a filter? The most right side, in other words, there's going to be two swing highs or two swing lows, regardless if it's relative equal high or relative equal low. The right one, whatever the one is on the right hand side, if it's relative equal lows, it has to be higher than the previous low. Does it do that here? Yes. So the condition is there that this is a high probability relative equal low for the purpose of drawing to it. Now here's a huge paradigm shift for you, okay? You're going to jump light years ahead in your understanding. The fact that we had the new day opening gap below that, that is a further like rocket fuel that this is going to be easy to trade to. But in the beginning stages, you won't know these types of things and you won't have the confidence to hold on to it. So you graduate into doing it by taking trades just to aim for this, and then you paper trade, or not, I shouldn't say it like that. Paper trade, like if I say paper trade, you're going to say, okay, so in other words, demo trade it. No. Yes, you can demo trade it or tape read it. So in other words, if you're going to get to the point where you trust it, but you can't hold for a move down here because you just can't find it in yourself to do that because you're watching the profit grow and grow and grow, and it's probably the biggest trade you ever had in your life. And now you have anxiety because you're afraid that if you don't take the trade off while it's at the biggest point of profit since you put the trade on, what happens if it reverses and you're going to feel bad that you didn't take out the full 1,000 or hundreds or whatever the size is that you're trading with, then leverage and affording you that profit. You're going to be worrying about that instead of watching and seeing, is price still behaving in a manner that supports the idea of it reaching to this level. Okay, so number one, to hold on to trades longer, you have to have something outside of the normal range that you would trade for. So if you're graduating from 25, 30, 50 handles, there has to be something that points to price going to something beyond that. Okay, so if we're looking at that lunch hour and we know that there's news coming out at 1 o'clock because of the bond auction, I'm a little bit more, I don't mind risk. Let's say it that way. Okay. If I do something wrong, I can go back in and generally fix that problem. Okay. I can like mitigate that. Or when I was doing dominoes, I used to manage the dominoes when I was younger. We had a running joke for any new hire that came in. If I was running out of dough, I would usually take the last dough and put my hole through it before I slapped it out into a pizza. And I would show the new hire and say, look, go into the freezer and bring me the dough repair kit. And it's a running joke. Everybody that works there knows it's bullshit. There's no such thing as a dough repair kit. But they'll look at you, nod, and they'll go into the freezer and look around for something that says dough repair kit. There's no dough repair kit. So I say that because you have to treat your boo-boos in trading just like that. If you make a hole in the dough when you slap it on a pizza, just flatten it out, roll it out, and it's fixed. Pinch it, roll it out, and it's done. In trading, when you have a loss or if you did a poor placement, you took the trade a little too quick. You were trying to anticipate the setup versus waiting for the setup, and you may have to get out of it and wait for the real setup to form. And you may get a drawdown. You may get stopped out, and you may need to do something else as a later setup. Well, the mindset that's needed to do that has to be in play also, because if you're going to be holding for longer term price runs, the potential for you to be stopped out prematurely increases exponentially. Because in the beginning, you don't trust that the market's going to still work towards this direction. Every little retracement is going to feel like it's bottomed because you don't have that experience yet. And when you start having these new day opening gaps and new week opening gaps and start waiting for price to gravitate towards them, that is like an exercise that strengthens your patience. But you can't fast track it. You can't make it happen faster because you want it to be faster. Like, you just can't download the experience of saying, okay, I'm just going to hold for these new week opening gaps or new day opening gaps, and I can trust it because ICT said so. So that's enough. No, you need to see it for weeks and months, and then over time, oh yeah, I can see what it's trying to do, and I'm not going to get tripped up by all these little fluctuations. But with that said, just know that there's a graduation point that you have to go to, which would be using this area right over here. So that's what I've been teaching you so far in the first two lessons, that we're looking for these types of things when the market is likely to go lower. What are we looking for? Caleb, we're looking for these types of things here. A higher low than the previous one that are in close proximity to one another. So this is a target that we would use to aim for going short at a time when the market is going to be used to accelerate around that bond auction number at 1 o'clock. If you look in here, right here, zoom in a little bit. You can see this is not market replay. All right, here's one of those 81 PD arrays. Okay, the market trades up and starts to roll over. What time of day it's at? It's 12:42. So what are we approaching? We're fastly approaching what? That 1 o'clock hour, and the news is going to be released at 1 minute after 1. Okay, so basically it's 1 o'clock. So 1 o'clock, the bond auction number is going to be released to the marketplace, and then everybody does whatever they're going to do based on that. Okay, so the understanding is this: that number comes out, and then traders are going to buy and sell, and the buying and selling pressure after that market release is done pushes price around. Bullshit. What's actually happening is the market's already starting to run lower. This candle here trades up. I want to see it be sensitive. Let me take this execution off for a second, and I'll put them back on in a moment. I want to be able to show the candles, and this shit's in my way. This candlestick traded up into this gap. Now, if this was a PD array that I wanted to trade on, that would be my entry. But because I'm trading ahead of, this is the stuff that you write down, because these are all questions people used to leave on Twitter to me when I was doing Twitter Spaces. These are always in question form in my comment section. My mentorship students have asked me this many times in email, in the place where we meet. All those things, it always comes up. Okay, what do I do if I am not going to trade the fair value gap? What am I looking for ahead of a news drop? Because sometimes you'll see me take a trade before the news or before the opening bell, and I'm recording myself doing it. And invariably, what will happen is how did you know it was doing that? How did you trust that it was going to go that direction? How did you know it wasn't going to go the other direction? And the assholes will say, well, if it went the other way, you never would have showed that. And that's their cop out. But I'm going to give you the logic joker, so that way you can go start testing it and back test it and see it, and it's exactly what goes on all the time. Okay, so if I know at 1 o'clock that's when the news is going to hit for the bond auction. Okay, we already rounded over here, and we had a fair value gap there. The bodies are respecting it, and we started to displace lower. So just with this alone, looking at the chart like that, okay, if it's just looking like that, in your rudimentary understanding of what I'm teaching, you already know the likelihood that it's probably going to explore below that low. Why? Because that's where liquidity is. And it's been going down all day. And this is the time it stopped and came all the way back up here and moved lower. So what is it? Remember what it's gravitating towards down there. Okay. But now you have this short-term low here. By itself, that's a reason to be short. You have two factors. You have that new day opening gap as a larger like black hole wanting to eventually pull price to it. Then you have this low here where there's very short-term minor sell side liquidity. Okay, so there's sell stops below there. Don't be worried or consumed about the fact that these highs are relatively equal. Don't let that bother you. Why? Because the market's moving lower and it's pulling to this. And even if it doesn't trade there during the day session, because this is the day session low here, during the 7 o'clock to this point, this is the lowest it traded to at that time. So there's going to be stops below that for anyone that try to chase this going higher. These relative equal highs, they can stay in play. They don't need to be upset. They don't need to do anything. The market's going to stay heavy and keep working lower. How do you know that, ICT? Experience. The fact that this is still likely to happen. And think, what's over here in the London session? That low. There. So we have this low, and this. So what is that? That's three things. That's heavy factors on wanting to see price draw to it. There's no entry pattern there. There's no moving average, no indicator, no bullshit logic, except for its liquidity, and the market is operating on a narrative that it's going to drop to reach into that liquidity. Because if they're going to spend all this time above these relative equal highs during the 7 o'clock hour and 8 o'clock hour, and then they Judas swing into the 9 o'clock, well, this is all being held up there, tripping people up, chopping people up, grinding them all up, and then finally it breaks. I don't need to be a part of that, because the economic calendar, just like the TV guy used to do for me, would tell me when my favorite time in front of the box would be. At 9 o'clock on a Friday, Lou Ferrigno would turn green. He's the Incredible Hulk, Channel 11. I know where I'm going to be at. Well, the time on the economic calendar says that at 1 o'clock today, we have a bond auction. That's the only point of interest that I have on the economic calendar, and it's a medium impact driver. It's not high impact, but it's medium impact. So what that means is I want to be in the market anticipating this low being taken out, this low from London with relative equal lows. Remember, that's this over here. See that? That's going to be taken. And this is the part for those that if you are not able to hold the trade longer and you don't know how to get there, this is what you do. You take a partial below here and you close the trade here, and then you tape read the rest of it. And you journal the shit out of it. You journal every single time you feel an impulsive feeling or emotional about the idea that maybe if you think it's going to not go down there, that's when you screenshot it. And real quickly make a notation on it that I have doubts it's going to drop here. And then what you do is you look at that after the fact and say, okay, I didn't see this, so this is the takeaway. And you reinforce it positively. And by doing that exposure, you desensitize yourself to needing to be right. And it expands your comfort from getting into this trade and getting out. Maybe that would be the end of your trade. Or getting into the trade and then getting out below here and never seeing all this run down here. But it gives you that little cookie, that little reward that you did something. It was sound logic, but then you use everything past that time that you close the trade as a real focused oriented drill to build your experience and exposure to waiting for it to pan out. Believe me, it doesn't happen overnight. It's going to take you a long time to hold on to price runs that just go and go and go and go. And honestly, you're going to miss a lot of big runs if you want to trade like that. And if you allow yourself to be beaten up easily, and you'll do it. Trust me, every trader does it. I should have held longer. I wish I would have held on to it more. I wish I wouldn't have took all the partials off. I wish I would have held the whole thing. That's all toxic thinking. So when I answer a question like this, that's why it's very long-winded, because as soon as I mention anything about it, there's a series of new questions that will come up, and it'll feel like I didn't answer the question for you, which is why I opened the whole dialogue around it with, I know me talking about this isn't going to answer or scratch the itch for every one of you, but as a means of growing in the right direction on how to hold on to a trade longer, you do these types of things. And it's already been taught on the mentorship, and it's already on the YouTube channel. It's something I've talked about multiple times. But now, anyway, we're going to go back into this area right here. I got to zoom in on it. All right, so I know that this is the time when the market should start running, because that's when the bond auction numbers come out. Okay, we're up here. I know I have a real strong likelihood it's going to at least take this out and maybe run below here going into that 1 o'clock news release. Well, here's the 1 o'clock, and then the market drops. Here, what I was looking at is I want to see, does it do this? Does it run up into this fair value gap there? That's this here. There's your fair value gap. And what is it doing there? Does it at least touch the consequent encroachment or midpoint of that gap? Look closely. No, it doesn't. It gets real close to it, but it doesn't. Let me see if I can make it a little bit bigger. See? Just falls short of it. The fact that it goes up there and doesn't touch it and then closes here, I know that that right there is a bearish order block. I can trade after the next candles come up and bump in the bottom of it. I'll trade short there. All it has to do is move away from it and then come back up into that. I can trust this candle not being overtaken. What's the next candle do? Goes up to it, but doesn't touch this line, and it doesn't even breach the candle's high. Now, if it would have traded up and touched that midpoint and then did that, I would not have taken that trade. I would have waited for another attempt to get in there and work just a little bit above the consequent encroachment, and then I would try to go short in this upper part there. That's what I would have done differently. But because it didn't and couldn't even touch the consequent encroachment, these are PD arrays. And yes, they're used for very specific and static levels to enter and exit on. But I also use these same price points as a means of measuring strength and weakness. If this candlestick can't even touch that, but gets close to it, it's signaling. It's a signature. That's an algorithmic signature. For someone that knows what they're looking for, that tells me that when this candle closes, all I need to do is see it move away and come back up and touch the bottom of that, and that's a bearish order block. Yes. Now, with that logic, I can be short and take a partial below here, or if I know that I can trust that it's going to go down below the London lows, then I'll put a limit order below that. And then I could sit and explain to my son that I think it may go down to those lows, but I'm positioned now that if it doesn't need to do it today, it'll probably go down there in the London session tonight. Where? To the new day opening gap down here. So with all of that narrative explained to you, let's put the executions back on. There you go. So now we have the market displaced below the bearish order block. This candle here, we open and trades up. There you go. It trades up, touches it, goes short. There's your low. What's the low of that candle? Look right here. See that candle's, see that price right there? Right above my cursor. That's the low. What's the low of the candle? 18,320 and a quarter. Okay. The fill, 18,321 and a quarter. So as it's bumping into that, I'm selling short right there. And I want to see it aggressively run below here. It does. Go back for a second. The fact that we traded up here and we didn't touch the consequent encroachment of this, I like to see if there's two fair value gaps, because we have here and we have here. You have to at least anticipate that it may go up into that higher one. But if it fails at the lower one's consequent encroachment and there's a news driver coming, I have no problem, no fear of absolutely none of getting into the trade. If I did it wrong and I get stopped out, I've shown executions where I've done this. My students have seen it. It's on my YouTube channel. It was on Twitter. You see me get stopped out, and then I go right in there and I do another entry and it pans out. Or if I did it wrong and I know that my direction was off and I'm offside, I reversed and did the other direction, and then the partner just goes the other way. That is going to come by experience. So invariably, if I address or field the questions that come to me, a lot of these questions will be answered with your own experience, and it's an unfortunate cop-out sounding response, but that's the truth. You're gonna feel comfortable doing certain things that you aren't going to be comfortable even imagining doing at the beginning of your stages of learning. So I wanted to see this stay open. Okay, I wanted to see it fail to get to that midpoint of the lower one, because it failed there. Okay, wonderful. I'm not worried about it. But go back to what I was saying. If it would have touched the consequent encroachment in this candle, I would have anticipated trading up into the higher part of this. And then my stop loss would have had to be above the midpoint of this consequent encroachment. You see how I just gave you everything that is logic based. This is your guidance. These are the things I've already taught. They're in all the discussion points of everything I've ever taught on this YouTube channel. All these things, unless I said my students have never learned that, everything else has already been taught to you. But because you didn't write anything down and you didn't take notes and you're just falling asleep to it, because a lot of people use me as a lullaby and they just listen to me and go to sleep, which is fine. Whatever, I'm glad I can help you sleep good. But everything I've taught, unless I'm saying to you, this is the first time even my students learned it, I'm expecting you to already have it in your journal, in your points of understanding what these things are expected to tell you. But anyway, it drops down, and then we have an immediate rebalance. Okay, so we have the market trading down here. We have a big down close candle. The market trades back up. Boom, bumps into it here. Immediate rebalance, and then I get a little bit of heat here, but that does not take me underwater. This was only, it would still have like $1,700 in profit even with here. Why? How can that be possible? If I'm entering here, look at down here. If I'm entering short there, why isn't that giving me drawdown in the trade? Negative drawdown, let's say it that way. Because the larger trade entry is here. There's 6 contracts here, and you see me doing this all the time. This is my model: 6 and 4, 6 and 4. So 6 contracts at the higher price if I'm short. The secondary affords me, when I'm only doing 4 contracts, it affords me to trade above that entry. It's forgiving because it could do what? It can revisit this fair value gap. It can trade inside that, but I don't want to see it do that. So I had to have a little bit of heat there, but it doesn't fill it. It just goes up to that level there. And what is it doing there? Is it touching the consequent encroachment before it makes the swing high here? Nope. So what does that tell me? It signals to me, just sit back and relax. Don't do anything. Just relax. Move your stop to your first entry, minus 2 ticks, and just relax. Just relax. And now we go into 1 o'clock. Look what happens at 1 o'clock. They pump it and then dump it. Small little fair value gap right there. All you're doing is you're studying price, and you're seeing every SIBI. Remember I was telling you yesterday, when the narrative's in play and it's going to go lower, or your analysis is assuming that it will go lower, you're looking at how the market is treated at every SIBI, sell sign imbalance, buy sign inefficiency, or a fair value gap that has a down close. It's defined by this candle's low, this candle's high, even this range is that far down. This is the only imbalance. So we have a little bit of an overshoot there. That's called a mohawk. It's just a coloring outside the lines. I talked about it yesterday. It doesn't change anything. It doesn't change it. Did it take out this high? No. All this is went outside the boundaries just a little bit, and the next one gives you peace of mind because what is it doing? It's stopping right at the high of the fair value gap. What's the high of that candle? You're going to look right here, upper left-hand corner. Look at that value right there. What's the high of that candle? 18,283.75. What's the low of this candle here? That's right here. 18,283.50. It's not going outside the realm of what you would expect price to reach to and then move away from. Is that proving to you that sellers and their selling pressure had the ability to stop it like that? It doesn't do it to me. You'll never convince me of that. You'll never convince me that sellers and buyers stop every bit of one of these turns in all these PA arrays right to the tick or the point or within a earshot of it. You're never going to convince me of that. And even if I didn't believe in an algorithm, I would think it was something other than that. But thankfully, I don't have to. But the market trades aggressively after 1 o'clock, after we have a retracement. So here we have model 2022. Here we have optimal trade entry. Easy, isn't it? It's easy when you have all of the guidance and rules in place. And you do the things that you're taught to do, focusing on the time of day and anticipating the delivery of price based on factors that call price to it. New day opening gaps, new week opening gaps, relative equal highs, relative equal lows. And then below that, in terms of importance, you have inefficiencies. Inefficiencies are subordinate and less important than relative equal highs, relative equal lows, or new day or new week opening gaps because their influence over price. The algorithm will refer and prefer more importance and significance placed around them. I'm not going to tell you the logic behind that. Just trust me on that. It'll serve you well. You don't need to know anything beyond that. When you drive your car, what do? You push the button or turn the key. You don't need to know how all that stuff works under the hood. Same thing here. Gaps, when they're actual, like new week open and new day opening gap, that is absolutely going to be much more significant because there's a lack of trades there. Inefficiencies, I'll say this much. You have one side of the delivery offered to it, meaning that, for instance, let's go back to this one here. This sell side imbalance, buy side inefficiency has sell side delivery. Okay, sell side delivery is always one-sidedness moving lower. Sell side liquidity is what's resting below that low. The London low, or relative equal lows, that this line is here, remember that's this over here. That's these over here, okay? That is sell side on the daily range. That's the lowest it's moved for the day, overnight, London. So it's going to want to try to gravitate to that too. That is real orders. That's not inefficiency. There's real pending orders down there. That is the lifeblood of the marketplace. Real buy stops, real sell stops. That is the heartbeat of what makes these markets go up and down. In between that, okay, in between that, you have inefficiencies. Inefficiencies have one pass through. So they have delivery. In this case, we have sell side delivery, but what is it lacking? Buy side. If I'm bearish, I don't want to see buy side offered because what that's telling me is I don't want to see it trade in the upper half of this. I don't want to see that at all. In fact, I'm enamored when I see it not even touch consequent encroachment. I basically get a hard on from that. I am turned on by that when I'm in a trade. I get so cocky and arrogant. You see it in my trades, or I'll annotate it. I say very facetious things because I see not just this signature, but other things I'm not going to share with you, and that pisses you off. Oh, you say you're an asshole. You're not teaching me everything. I'm teaching you more than anybody else would. And I'm teaching you how to make lots and lots and lots of success. Therefore, money, bread, dinero, moolah, fun coupons, right? The fact that we don't touch that consequent encroachment or midpoint, man, that tells you what? It's really heavy. Because otherwise, it would be natural for it to come back up in here, trade there, close it in, and it could still roll over. I don't like those kind of trades. That's Chris Laurie stuff. Chris Laurie stuff is let's fill the void. That's not a void. That's a sell side delivery. It's imbalanced. It's only sell side. It's inefficient in its buy side. It's not gonna be balanced if it just trades up there. That's not balanced. Okay? It needs to go there and then leave it. Then it's balanced. That's a balanced price range. So we're not talking about Chris Laurie stuff, and you need to stop leaving those comments in my section, okay? I made Chris Laurie a millionaire by pushing lots of people to him, and I'm never going to rip him again. I've seen emails where he's talked about me two-faced out both sides of his mouth. He can kiss my fucking ass. So there's your skinny on Chris Laurie. But the point is this. At 1 o'clock, we have an up-close candle, and it pumps it. And what's it doing? One candle is moving up. So people that are watching that, and they see this go up, even though it's a 1 minute candle, that triggers people that watch 1 minute candles. Hey, I watch ICT stuff. I watch people that trade smart money concepts. We're watching 1 minute charts. 1 minute charts is the bee's knees, baby. You can't make any money unless you're trading a 1 minute chart. When they see this do that, they're like, oh, here we go. It's making a failure swing. It's going to go up. And this is probably going to turn into an inversion fair value gap. And it's probably going to go for those relative equal highs up here. They chase something so minute and insignificant, losing the entire plot, that it's going to want to run the London lows. And now, as I taught you today, it's going to try to gravitate to new day opening gaps. And the market does, in fact, trade down below the London lows. And you can see my fill right there. So my limit order is just below that there. So if you look at the fills, 321 and a quarter, adding a partial pyramided entry of 4 more contracts at 291 and a quarter, scaling off the entirety of the position, 10 contracts at 18,213.50. So that is over 100 handles with the largest portion there, and that smokes all your favorite live streamers. Now, your response is going to be, but it's demo. My response is, this is how I teach. If it doesn't work here, it won't work anywhere else.